Regional bank Fifth Third posting a slight beat on the top and bottom lines, reported continuing loan growth and net interest margin expansion. Joining us to discuss is Fifth Third CEO Tim Spence. Stock's down about 2%, Tim, but overall the environment seems pretty decent when it comes to activity for your bank.
Yeah. Good morning, Sarah. Thank you. I think it has been quite good and will continue to be constructive. I think we were very happy. We were able to grow revenue by 6% year over year. It had 250 basis points of operating leverage. Result of that was the return on assets as a 1.2, return on tangible common equity 18%, and I think best of all, tangible book value per share for shareholders up 18% year over year. So it has been a constructive environment. We expect it to continue to be.
I know you're based in my hometown in Cincy. You have a good handle on the Midwest and sort of southeast of the country. What is the vibe right now? What is the mood from your clients?
Well, between GE Aerospace and Fifth Third, it's been a Cincinnati sort of morning.
Yes, love that.
Yeah, I think from a consumer perspective, consumers continue to be fine. The labor market has remained so tight that anybody who wants a job has been able to find one, and I think that's allowed them to keep up. There is some nervousness out there about the continuation of inflation, certainly on the business side of the equation. We have a lot of clients who are grappling with what the final trade policy will look like and what that means in terms of how they manage their own supply chains. But the clarity around the tax bill was an important step forward. I think the depreciation holiday that we're going to get here is a big benefit for anybody who wants to make a capital investment to support more manufacturing in the U.S. So that's quite positive. And if we see the tariffs settle out at a reasonable level and we get a real focus, a continued focus on deregulation, I think it could be a setup for a good second half of the year for the economy, in particular in the Midwest and the Southeast where we are, because it's the spine of manufacturing and logistics in the U.S.
All right. Are you putting some numbers on expected loan growth, especially on the commercial side?
Yeah, Carl, great question. We've been fortunate to have really good commercial loan growth over the course of the past 9 months, really. So we are growing loans at about 5% year over year. We upped our guide for the full year this year to be just north of 5%. And if we get a more constructive environment, I think potentially we could do even better than that. And considering where we've been, which was loan growth below GDP, it would be great for the industry overall to get back to a sort of GDP plus a couple of points level of loan growth. That Fifth Third's going to get there one way or the other.
I'm curious, Tim, how you're thinking about your scale right now. Obviously, you need scale to compete in banking, and the M&A landscape is a little bit different now that we have new regulators in town and potentially more encouraging of M&A. How do you think about competing with banks that are, 2, 3, 5 times your size? And do you need to get bigger?
Yeah, great question. Scale's beneficial in any sector. It's just the right kind of scale. I remind our folks that if we were fighting an army that was 10 times our size, we wouldn't march out into an open field single file, right? We would pick our spots and we would either utilize the terrain or the scale that we had in an individual market as a way of obviating what otherwise would be a disadvantage. And that has been Fifth Third's strategy. We're the number 2 bank in the Midwest. We're now the number 6 bank in the Southeast. We're going to be building another 200 branches across our Southeast markets over the course of the next few years, which will get us into a top 5 position in terms of the distribution that we have on the ground in those markets. And that's a very viable competitive position. If we thought you needed to be national, we would be building 200 branches, at 2 each across 100 markets. But it matters much more that you be relevant in the markets where you compete, because so many of the decisions for Main Street customers, which is really our focus, get made on Main Street, not across the globe.
Well, speaking of, that's diversification on geography and on Main Street. But what about capital markets? The banks have been raking in record revenues for markets over the last few months. I'm wondering if you feel like you're missing out there.
Yeah. We think there's a lot to be said from Focus and are quite happy with what we're doing. We have a very nice capital markets business here. It's been about $400 million a year in annual revenues. The focus really is on helping clients that sit inside our footprint, whether it's funding through bonds or debt syndications, or we have a very large business, an outsized business, just given our exposure to manufacturing and materials and logistics, in hedging out financial risk, whether that's rates or commodities or currencies and otherwise, and a nice growing M&A practice. So we're very happy. It's a middle market investment banking focus for us. I think it could continue to be much larger for us in the future. But you are not going to be seeing us competing with Citadel or Jane Street for market making anytime soon.